Tharisa, a co-producer of PGMs and chrome concentrates, delivered its full-year results this morning. Now, Phoevos Pouroulis, the chief executive of the firm, joins us to give us more details. So good to have you with us today, Phoevos.
Thank you for having me.
As stated in your numbers, you say the general mining environment is under immense pressure, but you've managed to turn a profit, which certainly says a lot about the measures that you've put in place. Walk us through some of the highlights, if you will.
Sure, thank you. And I think just by the nature of our business being an open pit co-producer of PGMs and chrome concentrate, we're well positioned in the low-cost quartile of producers. Having said that, during the financial year, we managed to maintain revenues fairly consistently at around $246 million, with an EBITDA number of $29 million, giving us a net profit after tax of $6 million, with a 2-cent per share headline earnings. So very encouraging in challenging times. Unfortunately, things are not looking better, and we've seen post our year-end prices under more pressure. There is a little bit of relief from the weaker South African dollar exchange rate, but really we've put in measures in place to reduce our costs over the next year, around 10%. Operating and overhead costs.
If we do look at the platinum price, at what level does it become unsustainable for you to continue producing here?
Look, we still have a decent margin in our PGM basket, so we can still withstand some more pricing pressure. On the chrome front, it's a bit more marginal. So running a co-production business, the one supports the other, but we need to put in these cost measures in this new year just to stem the tide of these depressed commodity prices.
When we do look at the map of your mining rights, you located to the greats in the industry, Anglo Platinum, Impala Platinum, Lonmin as well. And I take it for a lot of investors, as you say, you do open pit mining. We know that the neighbors that you have around you are more established and deeper into the ground. But isn't this an opportunity then maybe, now that they're struggling, for you to pick up some of their assets? And would it be profitable to actually consider open pit mining regarding the operations?
Look, I think the open pit opportunities are limited in the PGM space and in the Bushveld complex. So I think that's the first sort of preclusion in terms of our accessing those resources. In terms of the complexity of mining underground with the labor force numbers that you're talking about, the cost, the refrigeration cost, it's a very different model to what we have. You know, we're reliant on diesel energy predominantly, and mining is our main cost, with labor at around 7%. If you look at underground miners, the statistics are very different, and they have serious headwinds in terms of managing their costs, and we've seen restructuring within the mining industry around those costs. So from our perspective, we're looking at maintaining our low-cost position, taking measures in place around cost cutting, but also improving efficiencies and getting up to that steady state number. We're well on track to achieving that in the financial year of 2016. So we're just keeping our heads down and doing what we do and making sure that we maintain the momentum, achieve the productivity and the efficiencies that we've set out for with a lower cost base. We know China must also be causing you sleepless nights and headaches, despite the new deals that have been signed between the two countries. But from a demand perspective, we're just not seeing that pickup. Look, demand, fortunately for chrome, is still there. Pricing has come off in line with other commodities. So we're not seeing the appetite disappearing for chrome concentrates, bearing in mind that China has no resources of their own. So they're wholly dependent on imports of chrome ores and ferrochromes. So the demand is there, it's just the price which is the haggling point at this point in time.
You did recently list on the stock exchange. Does it still make sense, given the fact that you've actually seen your share price decrease by 80% since listing?
Look, it's a good question, because in this environment you're not getting the premium for being listed that we've seen historically. You're not getting those multiples, but we think it's a matter of time that the sentiment towards resources changes. It's very negative now. We've seen negative publicity, and it's a matter of stemming the tide and seeing through the next 12 to 24 months, I think, is our view. things are going to be pretty tough.
So give us an idea of what we can expect in the next 12 to 24 months.
So with our efficiencies, improved efficiencies, we should be achieving our steady state numbers in 2016 of 1.5 million tons chrome concentrate production and around 144,000 6E PGM ounces, which really is our target. So we're maintaining that momentum. We're on track to achieve that. And with that, our unit costs will reduce, getting those efficiencies and economies of scale in place. Coupled with our cost-cutting initiatives, we see ourselves still remaining cash flow positive and hopefully profitable in the future.
So you're going to stick it out for the long term, huh? Remain an optimist. Phoevos, all the best, and thank you so much for coming through today. We certainly appreciate your time. Well, that was Phoevos Pouroulis, who is the Chief Executive of Tharisa.